traders, welcome to another video from RLTR Group. This video is going to be different from all the others. We usually go ahead and give you a market analysis, but on this video, we are going to teach you a very beautiful technique about a hedge position and how to take a hedge position and reduce your margin by more than 70%. So without further ado, let's quickly go ahead, get to the charts and understand what is happening. I hope you have watched my previous video. And based on the previous video, let's say we have taken up a level at 33,612. Now, in this particular scenario, what I would want to do is I want to go ahead and, utilize the amount on my account in such a way that I get decent amount of profits and also not lose a lot of money. Now, that can only happen if you're using a basket order or a hedge position. Now, let me come ahead and teach you how to go ahead create a basket order. For that, there are a couple of requirements. One, you would need to have a $0 account. Two, you would need to have at least somewhere around 30 to 50K onto your account. But the process is a bit, more convenient, and there would be reduced margins as well that you can see. But I would want to tell you these are the two criteria that you need to keep in mind. Now, how are you going to execute them? Now, SEBI has been very, very strict with the kind of losses people make. And sometimes due to volatile moves, whoever is in a particular direction, actually lose out their entire capital if things go wrong their way. So to protect your capital, SEBI has decided to reduce the intraday leverage to as maximum as they can and have infused it with a hedge scenario. So now if you are going ahead and using a hedge position, you're going to get a lot of benefit. Let us quickly go ahead and see what that is all about. Now, let's say I think the price is going to go up. So I'm going to create a basket where I would say bull future basket. Let's say bull future. And I create it. Now over here, let me just go ahead and add a Banknifty April future. Now in this Banknifty April future, if I go ahead and buy a Banknifty April future for overnight, it is going to ask me for a 1,69,000. Now, like I told you on this video, that there would be a reduction in margin if you hedge your position. Now, look at the logical sense of this. How are you going to reduce your position? Now, what does SEBI want? SEBI wants to protect you from any volatile move. So what can be a volatile move that can actually go ahead, turn the tables down? Let's say instead of a buy, when you bought, the market fell 1,000 points. Are you going to protect yourself? Is it possible? Yes, it is. So what you're going to do is you're going to go ahead and hedge this with a certain position. Now, if the market is somewhere trading around 33,584, that is the future price, what I'm going to go ahead and do is I'm going to protect this with 33,000 put. And I'm going to add that right here. So as soon as I go ahead and add and protect myself from a 33,000 put, what is going to happen is the margin is going to be reduced drastically over here. But similarly, you can see the required margin is more. It says 1,78,000. Now, why does that happen? Is because the highest margin required instrument is on the top. So what you would need to do is you need to just click it, pull it down, and the margin then reduces drastically. Now, there is another thing that you can do in this particular scenario. Now, if you want to go ahead and further reduce the margins can then further be reduced when you shift them to an intraday. And then you would need to ensure both are intraday here and the margin gets reduced by another 30%. So with that, what happens is that let's say a market makes a volatile move and your future drops 500 points, but your option over here, which is 33,000 put, which is at 366, it would at least cover somewhere around 250 points depending on the implied volatility, and it will still save you money. You might not lose big, but there would be a small reduction of 200 points. Now, but if you would have taken this naked, one, there would be an increased margin, and two, you can't see yourself bleed for 500 points if you're wrong on that particular direction. So this is a particular scenario that I have explained to you over here. All right. Now, the second thing is, now I think the market is going to go down. Let's come back to the reference over here. And let's say the market is trading somewhere around 32,905 and you want to go ahead and trade this breakout of 400 points. So what you just need to do is go to your basket, create it as a bear basket or bear future. so that you understand which one you're creating. You can create it. And let's say the biggest instrument or the profit giving instrument for you at this moment is Bank Nifty future. And let's say you want to sell it and it is an overnight position. And let's say you add and the margin shows as 1,68,000. Now, what you need to do over here is very carefully remember the logic. You need to protect your upside. If you're looking at the downslope, if there is a sudden up move, what can protect you? Only a call can protect you. So let's go ahead and add 34,000 call. So as soon as I go ahead and add 34,000 call in here, which is a buy order, the margin gets reduced drastically. Now further, because the highest margin required instrument is on the top, and that would be the first one to get executed. For that, you need to have a higher required margin. But if you don't want that to happen, just shift it below and the margin gets reduced drastically. Now, what you need to do again over here is that if you want to further reduce it down, modify it to intraday and ensure both are intraday. And once you have modified it, the margin then gets reduced to another 30%. Now, this will go ahead and help you. Now, let's say the future price is 33,584 and you have shorted it, and let's say Bank Nifty makes a volatile move and it pulls itself back to somewhere around 500 points. Your call over here, which is at 274, would at least go ahead and protect 250 points depending on the implied volatility. So the maximum that you might lose over here might be 200 to 250 points, but that is the hedge protection that you have actually got here. So neither of these are going to turn red always. One of them is going to be green, so that will give you a bit of a psychological relief whenever you're in a position as well, so that you can go ahead, wait for your levels and attend this. Now, another most important thing is that this particular basket is not used for scalping, because future has a lot of charges whenever you go ahead and trade them, because their size is heavy, and because we have found a technique to reduce the margin, but the future is still going to hold the plight of giving you a lot of charges. Now, to reduce your charges, you need to ensure the basket order should only be executed if you have an idea of a 400 points. Now, if I wanted to scalp, I will go ahead and use a naked option position rather than executing a basket. So if you're executing a basket, you need to ensure 150 to 200 points must be a minimum for you to grab, so that can cover your STT charges and all that bullshit that actually the brokers have. So keep that in mind, and this is one way of dealing with this. Now over here, now there is another scenario that I wanted to introduce you to, and the reason why I want to introduce this is because this is a very volatile market, and we need to come up with certain strategies to protect ourselves and our capital in order to go ahead and be consistent in whatever we are doing. Now, if the price is going to go up here, there are two things that I can do. I can buy a future, or I can buy an option, or I can sell a put. So if I sell a put, because when the price of call goes up, the price of put comes down. All right. Now, let's say I want to become a directional seller. Now, for that, do you have a technique? Yes, RLTR Group has found a way out for you over here as well. And that particular way is, let's say I go ahead and say option selling, and I say PE. Now, I will tell you why. Because I want to sell a PE when the market is going up. So for that, what I will do is, let's say 33,700 is a particular PE that I want to short. Okay. Now, let's say I go ahead and add that over here. So let me just come back to the normal overnight margin. So if I want to go ahead and short 33,700 PE, I would need 1.4 lakhs, 1.5 lakhs decent. But remember, similar to the future, if you think the market is going to go up, what are you going to do here? You're going to go ahead and further protect yourself from any volatile move. Now, that volatile move can be protected with a PE that is on a reduced quantity. Let's say I hedge this particular position with 33,000 PE, and that is something that I'm going to buy. The margin gets reduced drastically. Okay, 75% reduction is too much, guys, or somewhere around 80. Now over here the same rule applies, and 1,66,000. So this selling particular option is this particular instrument has a highest margin that you would require. Now what I would want to do is I want to go ahead and shift the higher one to the lower one. So the required margin would be 41681, because this is also implying that we are going ahead with a limit order. Now let's say I go ahead and I change it with a market order. So the reason why the required margin is high than the final margin is because whenever a market order is executed, there are going to be some slippage in prices. So why am I introducing an option selling situation here? Because we have to protect our capital and hedge our situation. This is going to be the most critical part of our business, and we need to protect ourselves. Now as an option buyer, only if the price moves your direction you're going to make money. But as an option seller, even if the price is not moving to your direction, and if it is moving sideways, you will still get the theta decay that you are actually entitled for. Okay, so with that, the option buying has 1/3 win rate, whereas an option selling will have you a 2.3 win rate, and with the hedge it just makes it beautiful. So the maximum points that you can actually cover over here in this situation, if you capture your direction, is somewhere around 300 points, because 366 minus 666, let's take it as an average. So 300 points is the maximum that you can make. And what would be your maximum loss? Your maximum loss will be impedibly 300 points as well. So what then happens is, this is the correct protection that you would have onto your account. So this is an instrument that you would use when the market is actually behaving like how it was behaving on a Friday on a certain scenario that can actually help you. So this is when the market is actually going up. So option selling PE would be the situation. Now let's say if I think the market is going to go down, so I will go ahead and put option selling, and I would put it as C. So I will short a call instead of buying a put. So to create that, what I would need to do is, let us assume 33,700 is the current spot price. So I will go ahead and add that particular sell position over here and add it over here. It is going to straight away tell me 1,47,000. So what am I going to do over here is, I'm going to go ahead and protect this. Protect this how? I'm going to go ahead and buy 34,200 call, and I'm going to add it right here. So the margin gets reduced drastically by 70%. Now the required margin is always high, like I have repeated in all the other three scenarios as well. What you would need to do is, you would need to ensure that you pull the highest required margin instrument down, and that reduces your required margin drastically. So if you have a 50,000 in your account, you can go ahead and execute it. Now the beauty of this is that if you go ahead and do it on an intraday perspective, the margin further reduces drastically. So this is something I want you guys to keep in mind. So these are the couple of hedge strategies that we are going to use on our momentum breakout trading abilities to protect ourselves from undesired stress, undesired volatility, or any misdirectional shoot that is going to happen on Banknifty, because Banknifty is nothing more powerful than a Bitcoin, because it has a tendency to make close to 300 to 400 points. So with this, I conclude my session of teaching you about how a basket order is, and what is the strategy behind executing a basket order, and how to reduce your margins drastically. And with a small particular capital, you can go ahead and compound your way to success by deploying them. I thank you so much for your time. I wish you a wonderful Holi from RLTR Group to your family and your friends. We'll see you once again on our next video. Jai Hind, take care. Goodbye.